Hi, everyone. Welcome to the Skip Podcast. My name is Nikhyl Singhal. I'm your host. And this episode is devoted to compensation. It's probably the number one topic that I take on a weekly basis from friends and folks I coach and from my Skip CPO community. You know, folks are always trying to understand, like, hey, I'm trying to make a decision on an offer, trying to compare a few offers. How do I make sure I'm getting the right deal? I'm looking forward to this episode probably more than most, because if I put all the things that I say in writing and in a set of podcasts, my hope is that it'll help a lot of folks scale, and it'll help for all of the great tech professionals that we have out there. And it's a bit of a dark art. It's not a topic that, I find easy to explore on Twitter or, on Substack. And I've tried to tackle this in a few different ways. So a few years ago, I wrote an article on, kind of taking an offer letter and breaking it apart into its components. And you can find that on my Substack or in the show notes. Similarly, recently I wrote an article on just kind of really helping demystify equity. And in fact, involved a couple of my friends who are lawyers to kind of walk through all the different nuances of ISO options and RSUs and just the details around that. It's a really big topic and it's a really tricky one. But this episode is really trying to kind of look at it overall and just try to help you negotiate. And I'm going to be a bit more opinionated in this article than I have been, and recognize that, I'm not perhaps an expert in all matters from an accounting and finance, and I certainly don't know your situation. And so I'll try to be opinionated, but recognize that it's more patterns that I've been sharing with folks that I coach. And I probably do one, compensation package, every week or every other week. For this episode, we're going to use a Q&A format just to simulate the questions that you might be coming to me with when it comes to compensation. And the first couple of questions are really around comparing offers. And maybe the granddaddy of them all is, how much should I be making? And in fact, those two questions are so substantive that I'm actually going to devote part one of this series just to those two questions. So question one, I'm comparing a set of offers and I'm trying to figure out which one should I take. And this is one of the more tricky questions because it's hard to compare apples sometimes to oranges. And, though this is a basic question, it sort of helps this sort of set the foundation for the framework that we're going to use. And I've actually spoken about this framework in previous articles. My general push is that it's really hard to look at offers and compare them unless you're being apples to apples in terms of, one of two approaches. One is you can sort of say, hey, how much would I make this year? So let's say I join in January 1 of 2023. How much would I make in year one? And then you can compare that to what would year one look like and all the other offers. And so instead of looking at the overall, 4-year period, you just sort of look at what's the average annual salary. The annual expected value is the way that I tend to compare. And that annual expected value is obviously the easiest when you're looking at a public company. Because if it's a big tech company and it's public, then you just sort of add up the numbers. You sort of say, well, I'm going to get this much in bonus, this much in base, this much in equity. If I sold it, as I received it and the stock remained flat, this is kind of what I'd expect the numbers to be. But unlike big tech companies or public companies, private companies are a lot harder to value because a big chunk of their compensation comes down to the stock and the equity that they offer you. And it's not liquid. So because it's not liquid, you have to assign some kind of value to it, and the company and you have to come to some agreement as to what that value would look like. The company obviously is motivated to say the equity is going to be worth a whole lot more, and you're going to be motivated in a compensation discussion to say maybe it's not going to be worth a whole lot more. And so there's some delta between the company saying that their equity is going to be worth 10x and it's going to be easily liquid, and the company is never going to be liquid and it's going to be only worth 1x or less. And so all the money should be, guaranteed in some bonus or some cash. So this is probably the hardest part of the conversation with a company. And I think that what I usually try to do is understand, well, how soon is this company going to exit? The sooner it is, the more likely there is a liquidity event, which I think works in favor of your compensation, because then you'll actually get money for your equity. And it also means that you're probably not going to see a huge run up in valuation. If the company is getting closer and closer to an exit, meaning an acquisition or a public offering, my guess is it's not probably going to also increase by 10x. So, my sense is that, when I see something that's like pretty far along, I say, well, it's not unreasonable for us to say, well, maybe the equity goes up by 2 or maybe 3x in this period of time before you get to liquidity. And so if the company's worth $500 million, maybe it exits at $1.5 billion. And then we go and look at the math. Okay, if it's a $1.5 billion based on the equity they're offering, what would you end up making? And then maybe if it's a 4-year vest, divide it by 4. And that would be your annual amount. And you add your cash bonus and this amount. And that's roughly what you think. And then you compare it to the big tech opportunity. Now, if it's earlier stage, hey, I'm going to be the first head of product and I'm receiving 0.5% of the company. Now we're in a little bit of a trickier question, but we can say, well, if the company is, again, worth $100 million and we think that it'll end up maybe exiting at $1 billion or $500 million, it's 5 to 10x now, not 2 or 3x. And then maybe your 0.5% goes down to 0.25% because of the dilution that additional investors and employees will put in. Then we kind of have a sense of, okay, well, maybe that's 0.25% of $1 billion. And then you divide that by 4 years and we end up creating our number. And then obviously there's more risk that maybe the company doesn't get there. And then we look at that and compare it. Maybe this is a bigger number, but it's more risky compared to a safer bet with something that's a little bit later. And that's the conversation. So you get a little bit of a sense of how I shape these conversations with equity, looking at how far the company is away from exit. And then I'm trying to use either percentages or amounts to try to get to some kind of rough estimate as to what the annual amount's going to be. And then that's sort of the best of this imperfect guesswork that we're doing when it comes to equity. It's probably the hardest part of this whole discussion here. Okay. The second conversation really talks about how do you figure out how much you should be making. And I think that the sort of classic question I get is, I feel like I got screwed in the past on compensation, so I plan to negotiate as hard as I can. What's the best way to get the maximum offer? I'm just generally not a fan of this approach, because I feel like when you try to negotiate hard, particularly when you feel like if you don't, other people are going to be doing so, and it sort of, you don't want to be, leave money on the table. I think that either one or two things is going to end up happening. And most people are not great negotiators. And so what ends up happening is either you try to really take advantage of the fact that maybe you're, joining and it's hard for the company to find a good candidate like yourself. And the company ends up saying, well, great, we'll pay you what you want, but then the expectations are unreasonable. And then you end up having a short tenure. Or you end up always having, sort of this ISR on you as you kind of go about your day. And so you don't really want to start with expectations that are unreasonable just because you eked out a couple $100K. And then if you lose because you sort of feel like, well, this company's really an elite company. I mean, I'm lucky to be considered and I'm going to join, and, I'm not really that excited about the comp, and, but perhaps the company itself is just going to, do really well because maybe the equity is going to be worth it, or the brand value is great. Well, what tends to happen is at the first bump where the company obviously has some setback, you'll start to take that recruiter call. So if you don't negotiate hard enough, you'll always feel like, the company really should have, the company has to be perfect. And then obviously if you negotiate too hard, they'll think you have to be perfect. So we got to kind of find a balance here a little bit. So to me, the fairness question comes down to like, what is the price to retain your services based on what you think that you should be paid? And that to me is a slightly better approach, because it creates a sort of a sense before you even enter into any of these compensation discussions, like, hey, this is roughly how much I think I need for my next role. And if it's calibrated, then in some ways, when you get that number, you take it. And if you don't get that number, then you keep looking. And so I'm trying to get people calibrated to these sort of buckets of how much I think they broadly should be paid. And so I don't look at this specific company and say, let's get 20% more because we're going to negotiate really hard. I mean, that just doesn't really play out because there's just so many constraints in the system. So a lot of it comes down to your prior market data. So I'll spend a lot of time asking people, how much did you get paid in the past? Because that's a fact. And of course, there'll be questions like, well, I got paid and this company did this thing, or I didn't get promoted when I should have, but that's okay. But those are facts. And so it's reasonable for you to assume that you'll continue to make more money as you become more senior. So that's actually the easiest thing to look at is like, look, if I made $250K 3 years ago, and then last year I made 400, and it's not crazy for me to assume that you'll make 450 or 500 now. But if you said that, well, I expect to be paid $1.5 million, it's like, well, you could, but that seems like a big run up. So what exactly happened that led you to be able to see that break? And you're like, well, the market's paying so much. I'm like, well, no, your salaries don't quite work that way unless there's real evidence of some skill that you've been able to kind of close the gap on. So the price to retain my services based on past data is actually a good one. And then obviously the second is that how much does the role that you're taking, you're considering, how much is that role, priced at? How much do they typically pay to bring candidates into that position, right? And that's when external data comes up. When companies use external data, there's a few different companies that specialize in doing market surveys. And then they look at, say, in this case, a head of product role. And then they'll say, well, these are the different stages of company, from really late stage companies that are high value to really startups. And this is how much we typically see the cash and how much the equity typically comes out to be, right? So they use these external sources. What typically companies do is they get a range, right? So they don't get like a 600,000 number. They get a range which says it's somewhere between $500,000 and $750,000. And then the company has a philosophy around, do they pay at the top, bottom, or middle of the market? Some companies are very proud of the fact that they pay near the top of the market. Some of them are elite big tech companies like Google have always been known as, and Netflix have always been known to be, we pay at the higher end of the market. And then there are some companies that tend to be, conservative in how much they pay. And that's something that you can talk to the company about. You can ask them their compensation philosophy. How do they come up with these offers is a good question before you even look at the numbers. Do you end up using market data? Do you end up looking at past history? Past history, by the way, increasingly is harder to ask for companies. It's actually illegal in some states. And so there's, often the market data is more valuable these days because they want to be somewhat principled in how they come out with those numbers. But then even if they lose market data, you want to know, like, within the range, what's their philosophy? Are they aggressive? Are they conservative? Are they midstream? And the reason why that's important, especially if you're a manager, is not only does it affect you and your offer. Let's say you get a low offer and you're like, where did it come from? It may have come because they think you're a great candidate, but they just pay on the conservative side. Or it may be that they don't think that you're actually as far along. And we'll talk about this in a second. But the thing that's really important is that you have to go and hire people. So if you're going to go hire people that and they're used to being paid top dollar and your company doesn't, you're going to struggle in the company to build the team you want. And that's going to kind of be an important piece of this entire equation, right? So, how do you get this data? Well, you can find this data. Some of it's published, on the net. A lot of the VCs have this data. You can ask your friends who work in venture or who are close to those folks to publish it. You can talk to the recruiters. The executive recruiters have it. So this data isn't actually that hard to get. And you'll get these kind of PDFs with lots of different roles and titles, and it applies more to the executives. You don't tend to see it in ICs and managers, although there are some market data there. So as I talk to managers and executives, and particularly product managers, I'm going to now spend a little bit of time talking about product managers, and then we'll spin out to be a little bit of how does it compare to other functions. And they ask the question, how much should I be making? yes, I think that your past data is important for you to know what you think you deserve. And yes, I think that the market data is a big piece of this equation. But frankly, all of this market data I find incredibly confusing. And perhaps it's because I see these reams of data and then I hear these companies and they'll always say the same thing. Well, we pay really competitively and we use market data. And I just feel like it's a justification for any number they want to come up with. And so I've never seen a company that has been able to really, like, this conversation. Let's say you're having a conversation with a company and they say, we're going to pay you $500,000. And you said, well, I'm expecting 700,000. And then they say, well, this is how much this position pays based on this piece of data. And so the more that, a candidate comes to me and says, hey, I'm going to go and ask for a higher number from the companies that has offered me this package and I'm looking for data to justify it. I'm like, well, you'll find that data, but then they'll find different data. And that different data will show that there's a gap. And, you'll be in this arms race between trying to justify one thing versus another, and it'll never really resolve because they have their philosophy and you have your expectation, and it all kind of gets to sort of into a weird area. So instead, what I try to say is, well, the first thing I'm trying to glean as I talk to you as a candidate and you're asking for a position and trying to get compensation, I'm trying to get a sense of how elite you are. And I know that sounds like, elitist, but in some ways it is. I want to know, how special of a candidate are you? And in some ways, when we think about our career framework, a lot of it is to prove that you're unique or you're special or you're exclusive or you have some, superpowers. And so if you come to me and you say, look, I'm an exceptional candidate, maybe I'm exceptional because of the quality of companies that people are looking, or maybe the speed of promotion from your past, or how fast you've been able to have impact in your previous roles, you're an elite candidate and you'll probably be paid on the higher end of things, or you might be able to get an oversized role in your next position. If on the other hand, you've done fine, my expectation is that that's going to mean that you're going to drift towards more of the standard, ranges, or maybe even on the lower side. But I think that how, desirable of a candidate you are is the number one factor that'll play into your ability to negotiate, which is kind of an obvious point, but also where you phase into these ranges and how much you can command. So that's kind of note one. I think that if you knew how elite you are, you'll be able to know how much opportunity there is to push on the higher ends of the spectrum. And elite candidates get paid disproportionately high compared to average candidates, compared to mediocre candidates. Note one. Note two is, and this is probably the most important part of this podcast, is over the last 10 years, I've seen a series of buckets that tend to apply for most product managers when it comes to dollars that are getting paid. And it's funny to me that these numbers have stayed roughly the same over the decade. Before I give you the numbers, which I'll put in the show notes so you don't have to write these down, just a few caveats. First, the magnitude of these numbers really haven't changed as much as you would think over the years. Though, equity, of course, has become more valuable, the general expectations going into a job stays in these rough buckets. Second, these are Bay Area tech salaries for pretty strong companies that pay near the top of the market. They might be lower for weaker companies or, outside of the area, outside the US, outside of the even the region of the Bay Area and the US itself. And certainly less tech-oriented companies don't pay at these salary bands. Third, these are starting salaries, meaning that sometimes people join and then the equity, of course, becomes more and more valuable. But instead of using big, broad ranges, I like the specific dollar numbers because it really helps me calibrate if these offers are fair and how they compare against sort of other offers at the same bar. And then lastly, these map to non-product management functions like engineering and design, data scientists, and even business side. And I'll speak about it in a second, but I think they tend to shift downwards from these levels, but they all shift in sort of consistent ways. And so just understanding at least the product management bandwidth will be a pretty heavy start to your ability to kind of calibrate on your own potential offer. So if you're listening to the podcast, there is a link or a table in the show notes that I want you to try to pull up either after the podcast or even as I'm walking through the next few minutes. The table essentially has 3 columns. It has a bucket associated with a salary number. It has the responsibility that you would have if you were a product manager, and it had some sample titles. And these titles really are the titles that tend to exist within companies that offer that range of salary. Now, anytime you put out salary numbers, there's always going to be a bunch of hand waving. And the specific challenge is that I'm using a specific number, like $250,000. And that number implies that there's a range associated with it. Obviously, not everyone is going to be paid at that exact dollar figure. But what I'm trying to turn everyone's attention to is that these numbers, and they kind of look like 250, 500, 750, million, and then they get bigger. They get 2 million, they get to 4 or 5 million. These levels, if you will, are somewhat fixed. And so the goal in this conversation is to try to get people to figure out what bucket they're in. And then that is essentially the fair price to pay you. And you can get that at an early stage, at a mid stage, or a late stage company. But when you get those offers, you get those with some equity and some cash. And what you're trying to figure out is roughly how much is the annual amount going to be worth on exit. So what's my expected value? And then you're trying to figure out, is it in the range of the bucket that I'm owed? And that helps you calibrate, are you getting paid fairly? So that's the main point that I want to raise. And then I'm going to go through each of the rows here in a second. I also worth mentioning that most of my focus is working with executives on these sort of later levels, the 1 million, 2 million, 5 million numbers. And so the sort of earlier in career folks, those that are ICs, those that are in sort of this mid stage, the sub $1 million, those tend to have less variation, but they also, tend to be less known to me in terms of the specific details on 50 here, 50K here, 50K there. So just kind of calibrating that most of this focus is clarity on the executive ranks, which I think are very, very important. And then last note on titles, I think titles are really important to the individuals listening to this podcast, but are actually somewhat unimportant and in some ways highly inconsistent between companies. And so one of the biggest challenges we have in our industry is someone who's a director or product manager is paid one level with one responsibility in a growth company and totally different at big tech and totally different at an early stage. And so it's so inconsistent. I'm using the sample of titles to try to illustrate the point that don't tend to focus for compensation on the title because the title is not going to be meaningful. But I recognize that a lot of you, particularly early in career, really hold on to titles as a way to denote, hey, I have more responsibility, less responsibility, and companies are all over the map on titles. So we could do a whole episode on titles and what we should do here. But my bigger point is use this bucket approach of what lane you're in to figure out are you being paid fairly and what responsibility you should have, and don't map to titles. Okay, so for those of you looking at the table, what you see here is 3 levels and then a jump to sort of senior leadership, and then the next 3 levels. So I would start by saying that the first level is sort of the entry product manager role, and it's about $250,000 annual. And then you move to the first-time manager or a much more senior IC. These get paid roughly the same in a company, and that's about $500K. Now, I talk to folks and they're at 450, some that are at 600, and there's an overlap between these ranges for sure. But 500 is kind of the average, or maybe the low average of this camp of this first-time manager. It's about twice what you would get paid when you start your career. And The senior PM title tends to be used pretty often here, as well as the sort of manager, product managers, or PM manager title. Now, what the next level shows is that you tend to see the topmost ICs that some companies don't even have. This principal product manager title sometimes gets thrown around, and that's at 750. And so you're seeing a natural progression. And the top IC, or the manager of managers in some company, they call them group product managers. In some companies, like at mid-stage or growth stage, they call it director of product. These are sort of your next rung, and they often are managing a more seasoned, a larger project, but they're not quite managing managers yet. So that's the sort of next level. And it's sort of the 750 range is sort of this natural progression. And then, of course, you get to this million range. So far we're tracking, and now we're at the sort of leadership level. And at this level, you're really managing managers, or you're a product team lead. And so you see head of product in early stage get this salary of about $1 million and the expected comp that they would get on exit. And you also see the sort of VP of product that would exist at a growth company. So if you had a CPO, they would have directs. That CPO would have these VP of product. They would be managing other managers, and that's about $1 million. And then you also see directors at big tech have roughly this salary. Now, is it exactly million? No, I've seen 0.9, I've seen 1.2. And then you might be saying, no, I'm a director at big tech and I make 1.4. And I'm like, well, you make 1.4 maybe because your stock's gone up. But if you were to leave and come back, you'd be probably closer to the $1 million range. So this $1 million number that I'm going to just spend a minute on essentially says that you have the skills to manage managers. You can take a pretty big chunk of the product and lead it. And whether you work as the head of product at an early stage company, and number 2 at a growth company, or you're working as a director at a big tech like a Google or a Facebook or an Amazon, you're in roughly this range. This is the point of this podcast, is to say, look, the bucket is relatively consistent, but the responsibility of what is titled is super different, but it's roughly the same skill level. Now, of course, we jump up to product area lead, and if companies that are a little bit further along, they have more sophisticated needs. They may need a head of product, or maybe they call that a chief product officer, and that person's actually managing the folks that we just described, the directors, the VP of products at a growth company. And so when you're managing, or you're a head of product of much larger territory where you've got multiple products, multiple functions, you're in that 2, maybe even as much as 3 million range. I think it tends to be closer to the 2.2 range, but I do see things run up, particularly when equity gets closer to exit. And that compensation is usually titled around the sort of chief product officer at a mid-stage growth company, this sort of maybe early public or later stage company. And you also see the senior directors at big tech, the ones that manage the directors at big tech, get this 2 million. And then lastly is these elite roles. Now, these elite roles don't exist in most companies. But these elite roles are paid dramatic amounts of dollars. They are designed to scale and expand a product line. They're at the elite career. And usually companies that are hiring these folks are either elite themselves, meaning that they're one of the very few quality growth companies that they're looking for a chief product officer, probably managing more than just product management, or there's a VP position at big tech. And this position is much, much larger, and it is for the top candidates, and it gets paid at this $4 to $5 million range. Okay. So you can see that it starts at 250, 500, 750, pretty predictable, goes to about $1 million when you break into leadership. And now we're at this sort of doubling, 2 million to 3 million, 4 million to 5 million as the company gets higher quality and the candidate pool gets much, much smaller. So what's the first thing that you conclude when you say, well, let me get this straight. I start out at 250 and get to 500, 750. And then all of a sudden I see this sort of manager of managers and I get to $1 million. Now I've sort of seen, okay, 250 along the way, but then I double my salary if I become my boss. To go from like a director to a head of product is like, twice as much. And oh my gosh, I more than double it if I go from a head of product to a chief product officer for either elite company or when I run multiple functions. It seems like I should be getting that job instead of maybe the fastest way to get those jobs is so important. And now you understand why we spend so much time with these chief product officers, because there's such an exponential growth in salary and why the expectations are so high when you take that role. And so unfortunately, tenures tend to be inversely proportional to this compensation. What I mean by that is that 10 years and you're 5 million, you're on the hot seat. So it's not unusual for these folks to maybe only make it 2 years, as I've said in the past. But, if you're an IC or a manager, your tenures can be almost infinite. It's usually up to you as to how long you want to stay. So there's an exponential growth to these layers that tends to exist. And so in many ways, a lot of my conversations with all of you is how to make sure that you're building the skills to be successful in these leadership roles, because those are the ways you not only get comped the most, but it's where you have the greatest impact. Now, a lot of times people are going to ask me this question around, well, I'm not a product manager. Can you help me with the same concepts? And my general sense is that engineers have typically been paid a little bit higher than product managers. So these numbers go slightly above for the engineering levels than they do the product management levels. Maybe not so much when you get to the final executive roles, but generally engineering leaders are, because they obviously are managing much larger teams, they're closer to the build of the company, they have longer tenures for sure, and they tend to get slightly higher. So if you look at the sort of the data that exists in the market, you'll tend to see the more engineering to be about 10, 20% higher, and you tend to see design to be about 10, 20% lower. And this isn't a judgment for me or maybe even in the industry. It's just generally like this number of people and the kinds of expectations on comp and the comparables. You tend to see a little bit of drift below and it tend to be a little bit of drift above. But that's generally the range. I'm not as familiar with the business side, just to be completely clear, but you can use the same template to sort of get a sense of like how much you should be making, right? Now, what I am now going to be able to do, if when you come to me and you say, hey, I have an offer, you can see I'm very quickly calibrating between like, well, which bucket are you in? So if you're a director type person where you have had success in managing managers, you may have been a senior manager or director at a big tech company in your past role, or you've taken a number 2 role at a growth company. And I'm convinced that you can be a director at that level. I'm going to be thinking 1 million in my compensation conversations with you. My expectations are going to be around $1 million. And if you tell me that hey, how much did you make in your last company? And you're saying 1.4, I'm going to be like, well, you're being paid a little bit above market. Congrats. Maybe the stock ran up and you ended up getting a great number. But then if you walk in to a product role where you have to build the product management function and it's a head of product, and you're like, well, my buddy got a $5 million offer to be head of product, and I'm only getting $1 million with this equity that I kind of calculated. I'm like, well, $1 million is basically the director range, and that's probably the role that they have in mind for this position. And so it's not totally out of market that they're asking you to make $1 million a year. And the fact that you made more in the past is really congratulations to you, but you're an outlier. But the market doesn't pay that. So I'm not necessarily feeling like you should be forcing that up because that's the range that they should be paying. Now, on the other hand, if someone comes to me and says, look, I got $1 million offer, and I said, well, what's the state of the company that you're asked to kind of lead? They're like, well, it's got 6 to 10 PMs. There's a little bit of design that they need help with, and I'm part of the management team. I'm like, well, if you're that's closer to my 2 million range. So if you're getting $1 million offer, I think you're probably off a bit. I think that there's maybe an issue here where they're underpaying you. And if you're qualified, you could probably get a senior director role. at a late stage. And then we do a little bit of a test. Hey, do you think that role, would you qualify if you were to go interview for a company of that level? Do you have the experience to get that not just director, but senior director type position? And if the answer is, yeah, I think it's credible that that's where you would slot in if you were to successfully interview for, with an Amazon or a Google or a Facebook or a Microsoft, I would say, okay, well, that's kind of your market range. But you can see I'm trying to kind of get a sense of where the market sees you, what the range is for that position. And that will then help me understand what's fair, and then if the company is calibrated incorrectly or not. Obviously, if you're an elite candidate and you're looking at a top 5, top 10 role in the marketplace, and they walk in and they say, I'm going to get an offer for $5 million. I'm like, well, you're probably at the top of the market. You might be even able to get a VP role at a late stage tech. That's kind of what I expect and that's what they'll need to pay to attract someone like that and pull them out. So that's, again, this sort of idea around how I end up looking at these buckets and determining if you're off or not. You can tell, though, that the flip side is that if the position is a 2 million position and you've been paid 3 or 4 in your past, then it's pretty unlikely that the company can justify just changing their compensation structure just to be able to reach for you. You might deserve that because you can get that elite role, but the opportunity here is that that is how much that role should have paid, because they should be looking for senior directors. And if you're a VP, you have to come down to take that role. And that's why I'm a little bit more cautious and a little bit less aggressive about negotiating, because I do feel like in this example, where you're used to being paid more and the position, is rightfully a 2 million position, it just makes less sense for you to be able to move the number up unless there's something really exceptional about the need that they have for you to come on board. Okay, so to wrap up, boy, there's a lot of numbers that I just shared with you, but I'm hoping that you were able to get a sense of how I compare offers and how I use, your market rate, what you can essentially earn in the market, as well as what amount of money a role should be paying to connect the dots on whether you're being paid fairly, and ultimately how to compare offers. In the next compensation episode, part 2, I'm going to get more into the details of how I help executives negotiate, how I help them think through how to talk to their employer about perhaps getting additional compensation. And most importantly, just sort of demystifying some of the myths around numbers and dollars and how to think about those kind of details amongst all of the different parts of your career. So stay tuned. Please leave any comments or questions that you may have that I didn't cover. And thanks for listening to The Skip.